For a trader's take on everything that's been happening over the weekend and what will influence trade this week, I'm joined here on the floor by Stephen Guilfoyle of Meridian Equity Partners. Out in Chicago, Bob Iaccino of TraderOutlook.com is watching bonds, and Scott Sheldy of ICAP, also joining us from the Chicago Mercantile Exchange, is following currencies. Sarge, not a lot happening overnight, but it looks like it could potentially be a big week for equities. What's going to influence the trade?
Well, like you said, this week's going to be pretty big. We got retail sales, we got the Fed, we got inflation, we got manufacturing, but that all starts tomorrow. All right, as you said, it's kind of quiet. Everything's pretty close to where it went out on Friday night. Every sector, every index. What we're looking at is today, we got the news coming out of China, terrible trade gap numbers, so they're probably going to have to ease. And we got the ministers in Europe finally trying to put Greece to bed. But I think they'll only probably put it down for a nap, and it'll wake up needing to feed once again. Well,
you have that wait and see, and that, as you said, perhaps finally putting the last bit of ink on, signing that $170 billion check to Greece. We expect that to be happening today. But what is really influencing the bond trade today, Bob? I mean, you've seen some selling of treasuries and looking at the 10-year note yield still above 2%.
Well, there's a lot of concern out there with what's going on from a perspective of who's going to buy these treasuries down the road. Bond yields are much more likely to move before Operation Twist ends without some sign from the Fed that there's going to be a little bit more QE, QE3 as everyone's been saying. I think that has to happen from the Fed. Barclays put out a table last week showing that since about September of 2011, the Fed has bought about 58% of all treasuries issued and about 91% of treasuries between the 20 and 30-year maturity. So when Operation Twist ends without some sign from the Fed, you can see those yields rise dramatically.
Bob, midweek last week, QE was on. End of last week, QE was off. This Monday, it's back on? Is that what you're telling me people are talking about in the pits?
Well, you know what? Welcome to the world we're in right now.
Scott, what's that?
Sorry. Welcome to the world we're in right now. We've got this situation where we've got slow growth, both in, obviously here in the States, but I think that the recession we're going on in Europe, we're continually putting this fertilizer on everything, and it's what we need to have happen is we need real growth. So I think that with the currencies, especially with that euro, I don't think it's going to really get out of bed. And I think that because of what's happening in Europe, and we can take a nap on Greece, or we can slowly but surely sleepwalk our way through it, but it's a much bigger problem than we're letting on to believe. And I think that ultimately those fears are going to come back to the market, and the dollar's going to get a boost just because. So look for that dollar to strengthen. I think the euro weakens.
Yeah, we have the dollar strengthening here. But Bob, jump in here. What are you expecting out of Ben Bernanke and the FOMC tomorrow?
Well, I think that the QE3 being off was a little bit of an assumption by the market because of no mention by the Fed of being ready or being vigilant or watching these rates and watching what's going on globally. They just were kind of silent. So I think in terms of it being off was a market assumption. In terms of it being on may be what Bernanke tries to actually convey. Because again, when Operation Twist ends, you see China also steadily decreasing, slowly but steadily decreasing their holdings of U.S. Treasury. And a massive spike in rates is not good for anyone, with the U.S. being really the only place where you can reach for yield, both from the equity markets and from corporate bonds. High-grade corporate bonds are still looking very good from a perspective of having a better balance sheet than governments do.
All right, Bob. Thanks very much, Scott.